All right, let's dive right into this explainer and build your ultimate exam battle plan for advanced accounting. Welcome back, everyone. If you're gearing up for your upcoming CA intermediate exams, you already know the deal. Paper 1 demands way more than just basic math. It demands precision, statutory knowledge, and a bulletproof strategy. Today, we're taking the source material straight from your advanced accounting chapters and transforming it into a highly focused visual masterclass.
So, here's our roadmap for today to maximize your marks: advanced accounting exam strategy, mastering buyback calculations, solving a buyback case, amalgamation purchase consideration, internal reconstruction journal entries, and finally, a summary and some examiner tips.
Quick question for you before we start crunching the numbers. Do you know the exact order to calculate the 3 buyback tests? You really need to nail down the statutory sequence that examiners will actually grade you on. It's not just about, finding a number at the end. It's about proving your legal compliance step by step. If you do these out of sequence, you're literally just throwing away crucial points.
All right, Part 1, Advanced Accounting Exam Strategy.
Let's establish a really clear, pragmatic strategy for tackling these calculations under intense time pressure. The absolute key here, you don't just need to know the math, you've got to prove to the examiner that you truly understand the underlying Companies Act statutes. When you set up your answer, always state the rule first, write it out, and make sure you're using the exact formats prescribed by Schedule 3 of the Companies Act 2013, specifically Division I. This is what shows the grader you're a professional accountant, not just a human calculator.
Moving right along to Part 2, Mastering Buyback Calculations.
Okay, notice how the statute specifically includes the securities premium account as a free reserve here. That's a super vital resource for buybacks. But watch out for this trap. Revaluation reserves represent unrealized profits, and they absolutely, strictly cannot be used. So keep those definitions locked in.
Now, 25%. This number represents the absolute maximum limit. Under Section 68, a buyback in any given financial year must never exceed 25% of the total paid-up capital and free reserves. And get this, the buyback of equity shares specifically cannot exceed 25% of the total paid-up equity capital. Remember, this is a hard, unbreakable legal ceiling. Examiners love to test if you'll accidentally blow past this limit in a practical calculation, so always keep this cap in your head.
And then we have 2-to-1. This brilliantly illustrates the post-buyback safety net. The ratio of debt owed cannot be more than twice the capital and free reserves after the buyback. You probably know this as the debt-equity ratio test. Now, a quick clarification. When we say debt in this context, we mean both secured and unsecured debts. This rule basically ensures that even after shelling out cash to buy back shares, the company is still totally solvent and creditors are fully protected.
So you absolutely must execute these big 3 tests in this exact order to figure out the maximum number of shares a company is legally allowed to buy back. First up, the shares outstanding test. Calculate 25% of shares outstanding. Second, the resources test. Calculate 25% of your resources, which is your paid-up capital plus free reserves. And third, test that post-buyback debt-equity ratio. The final permissible buyback limit, it's always going to be the least of the figures derived from these 3 tests. No exceptions. Which brings us to Part 3, solving a buyback case.
This is usually where the hardest math sneaks up on you. When you're calculating the maximum equity to be bought back under the debt-equity test, you're frequently going to need this simultaneous equation method. Basically, you're trying to balance the capital redemption reserve, or CRR, transfer. Think of it like a giant puzzle. You take your present equity, subtract X, which is the nominal value transferred to the CRR, and then subtract the minimum equity required to maintain that 2-to-1 ratio. What's left is Y, the maximum permitted buyback amount. Seriously, take the time to clearly map these variables out on your exam paper. It will absolutely save you from those careless, kick-yourself calculation errors.
So many students lose marks by forgetting this next crucial step: excluding the amount transferred to the CRR from the present equity when you're calculating your future equity. Why? Well, because CRR can only be used to issue fully paid-up bonus shares. It's locked away in a vault, basically. It's not a free reserve, so you literally have to strip it completely out of your future equity calculations to get an accurate picture.
All right, let's pivot a bit to Part 4, amalgamation purchase consideration.
Under Accounting Standard 14, what exactly is purchase consideration?
The really crucial point to remember here is that this definition is strictly 100% limited to payments made to the equity and preference shareholders. It is simply the price payable by the transferee company to the transferor company for taking over the business. That's it.
Now listen closely, because here is a massive examiner trap. If you include debenture payouts in your purchase consideration calculation during the exam, you will lose marks instantly. Even if the transferee company agrees to take over and completely discharge the debentures of the transferor company, that payment is entirely outside the scope of purchase consideration under AS 14. Keep those creditor settlements totally separate, okay?
Moving beyond just the definition, we have to look at the methods of amalgamation. Keep this comparison top of mind, because your entire accounting treatment shifts depending on whether the amalgamation is in the nature of a merger or a purchase. A merger uses the pooling of interest method, essentially just adding the existing book values together. But a purchase uses the purchase method, where fair values are recorded, and any gap between the purchase consideration and the net assets becomes either goodwill or a capital reserve.
Let's move right along to Part 5, Internal Reconstruction Journal Entries. When an internal reconstruction scheme is court-approved, this temporary capital reduction account becomes the central hub for capturing all the sacrifices made by shareholders to clear out lost assets. I like to think of it like a giant financial sponge. Whether shareholders are surrendering shares or reducing their paid-up capital, the value of that sacrifice flows directly into this account to absorb and completely wipe out the accumulated losses.
Let's look at how this actually plays out in a journal entry. In this specific scenario, a 12 lakh rupee debenture liability is settled with plant and machinery that's worth only 9 lakhs. The company essentially scored a 3 lakh rupee benefit from this compromise. So what happens to it? That remaining balance moves directly into the capital reduction account to help clean up the rest of the balance sheet.
Once all those sacrifices have been credited to the reconstruction account, you use those funds to eliminate the garbage on the balance sheet. We're talking P&L debit balances, overvalued goodwill, and reconstruction expenses. And always remember, if you have any leftover credit balance in the reconstruction account after this big cleanup, it must be transferred to the capital reserve account. Do not put it in your standard P&L.
Finally, Part 6, Summary and Examiner Tips.
Okay, here is your ultimate 30-second cheat sheet. Memorize these statutory limits. Test your buybacks in the exact sequential order we covered. Avoid that sneaky debenture trap in AS 14. Never, ever include them in purchase consideration. Make sure you clearly map out your simultaneous equations for the CRR, and use your capital reduction account as the ultimate financial sponge during internal reconstructions. But you know, theory is nothing without practice. It's one thing to nod along and understand the 2-to-1 debt-equity ratio. It is another thing entirely to build the resulting balance sheet flawlessly under the strict Schedule 3 format. Take these frameworks directly to your mock exams and watch your calculation scores soar. So the real question is, when you sit down in that exam hall, will you freeze or will you execute? Stop reading, set your timer, and start calculating. Good luck, and until next time, stay focused.